Hello, everybody, and welcome to this space. We're here recording this conversations that we've been having. And whether you are watching this today with us live or you're going to be watching this later on in the recordings, this information is pertinent. So please reach out to us if you have any questions, if there's anything we can do for you. A little bit about ourselves. We've been in the real estate business since 2006. We started in the small homes and multi-families, and in 2020 in September we started going into more passive way of investing. And the reason why is because we value our time. We found ourselves with a second and a third job managing our portfolio, and it makes sense that to scale we needed to pretty much find partners and leverage on people's knowledge and time and money. So we understand how investing as a group or in a syndication, it makes it more feasible to achieve your goals, to scale and to build your portfolio. So here we have a series of conversations. Pretty much it's very casual. We'll be sharing information, questions that have been asked during those one-on-one calls, and we just want to put it in a way that it makes the impact in more people. We also wanted to share our information or deals in which we have been invested and their performance and pretty much how we pick them. So we wanted to give you those tools so that when you're ready to find a deal, when you're presented with a deal, you have the foundational knowledge so that you can make those decisions for you and your family. So here it is. Chris is here in the team as well. If you don't know about him, he's my husband and my business partner. So I'll let him spend a little bit of time with you guys.
Good evening. I am a retired person who has started doing real estate full time as of last September, as Maricela said, in 2020. Additionally, I have an MBA, helps us to understand the numbers better and understand the business side of things a little bit more than the average person. We're going to go ahead and get started on talking about passive investing. Maricela is going to share the screen.
Yep. So
and we'll start off with a disclosure that basically we're not offering anything right now per SEC regulations. We are here just to educate, provide information. If you are interested in potentially becoming an investor of ours, please reach out to us and let us know. Go to the disclosure page.
I'm working on it. There you go. This is our disclaimer.
So we have the disclaimer here for you. You can read that at another point. But again, this is not an offer to sell, solicit, or offer to buy, or a recommendation to purchase any equity or debt. Anything that we show you here today is basic knowledge, and we will discuss a case study later that that deal has closed. It's already been performing, and it is not an offering to you at this time. Again, if you're interested in something, please reach out to us at a later date.
So thank you, Chris. So a lot of people ask us, what is specifically type of investing are you doing that you're able to scale in that much fast and large numbers? You know, some of the places that we purchase, we would never even think of it before, over millions of dollars. So the definition of a syndication is pretty much grouping together and buying something that combined as a group we can actually afford, and individually we probably will never be able to make it work. So this is also called group investing, and there's definitely in syndications there's two partners, limited partners, which are the passive investors, and the general partners, which are the active investors. And this is pretty much a partnership. So even though you're a passive investor, you are a co-owner of this complex or this property. So this is pretty much, I also, so to remind myself here, I will be sending you, or we'll be sending you this slide, all this information will be available to you, so you don't have to be taking screenshots or having to write. I'd rather have your attention on the screen. But yeah, you will receive this if you send us an email. But this is pretty much the definition of a syndication.
So do you need an LLC before you start passively investing? You can invest under your own name or under your entity if you prefer. It's completely your choice. It's only for tax purposes and income tracking that it makes it easier to do it under an LLC. To invest in apartment syndications, you can be a personal investor. You can put together a family and open an LLC and be able to invest that way as well. You make your own little partnership that goes in as one entity into the larger investment. As a passive investor, you're sheltered under the LLC. The asset that the asset is held in, that LLC holds the asset, and it will have named agents responsible for answering any legal engagements. As a passive investor, you would not get a phone call in need of attending court or anything like that, should there be any issues. Make sure you consult your tax or legal professional before deciding to create an LLC.
So a lot of people is sitting in cash that they could make this a way to invest, especially when you're first getting started. So a lot of people ask if they can invest with an IRA or a 401k. These accounts, yes, you can, but they have to be self-directed. So there will be a whole other session where we talked about how to convert your regular traditional accounts, retirement accounts, into self-directed. And we have used a specific company that we can refer you to. But yes, you can absolutely use those accounts to invest. Again, you make sure that you consult your CPA, because some of these transactions might be triggering an a taxation and event. So make sure that you're consulting your CPA or your financial advisor.
When someone sells an asset, they can file it in as a 1031 exchange, which is where they're trading up in value of the property that they just sold. And you can go into multifamily if you just sold a home or a quadplex or an eightplex or something like that. You can go into large multifamilies with a 1031 exchange. The key to it is that the ownership has to be the same owners on the moving from one property to the other. And in order to do that with the 1031, it requires that investor to be a tenant in common. So it gives you a slightly different role, still as an LP, but you get some more voting rights with the general partnership as well. Now, this is something that syndicators might not desire, and it also includes a significant amount more legal paperwork for this type of investment, and it adds an expense to the group. So they might charge you some extra fees to be able to do that. And again, not all syndications will accept a 1031 exchange.
Thank you. So another common question we get is how is the or the investment be owned by a person or an LLC? And I believe we briefly touched on this. The asset is held under LLC, and the LLC is created as a new entity when the sponsorship team goes under contract to purchase that specific property. So each property is going to be owned by its own LLC with no prior history of business. So there's no links to any debt or any bad reputation with that LLC.
What's the minimum amount? The minimum investment amount? Well, each deal is a little different depending on the amount of capital to be raised and the value of the asset and how many investors the general partnership wants to maintain and have to have relations with. Most deals have a minimum of $50,000. Sometimes you'll see an offering that is as low as $25,000. And we have actually seen some that have been as high as $100,000. Of course, you always have the option to invest more than the minimum. And sometimes investing more than the minimum can also bring you different dividends in the deal.
Okay, another question we have currently frequently, are you invested in your own deals? So the answer yet is yes. So anytime we present you with a deal or a potential deal, it's because we believe in it and we actually have put money in it, or if they haven't closed yet, we are willing to put money in it. And that's just the way we function. And anytime we enter a partnership, we or partners are also required to be in as a passive investors. That is because we select our investments in a way that is beneficial for everybody. So being a active investor or a passive investor is just is the compensation is a little different, but we want to be as passive investors because we want to take advantage of all of those good things that we offer to others.
What are the timelines for investing passively? Well, we will communicate with established and potential investors as soon as we get a property under contract. In general, this is called a soft call for investors, and it runs concurrently with the due diligence period of the asset and bank underwriting. The inspections and due diligence process can take about 3 weeks to get all the results back, and committed investors usually reserve their spot in the first week. After the due diligence is completed, the investors are presented with the PPM to sign and transfer funds. Closing on the property usually will take place in the next following weeks.
This is just a visual to show you pretty much the timeline. First we sign or we go under contract. That's the PSA effective date. That's the day that we go under contract to buy the property. Then immediately after that, we do have a period of due diligence and inspections that is in person. We hire specific roofers to check the roofs, plumbers to check the pipes. Pretty much every aspect of the property is inspected. Along around that same period of time, we'll be making calls to make you aware, make this exciting news to let you know where we are and what we're doing. And as soon as we get a clear from the due diligence, then we put together a portal and investor webinar where you have the chance to go and learn more about the deal, about the market, about the specific building, the neighborhood, all the economy, the jobs. All this information is presented to you along with what the business plan is for this specific property. And then there will be a portal that is open so that you can go in, and it's very automatized. It's very user friendly. And yeah, you'll be able to go in there and pretty much submit your commitment forms. And again, after that, usually within the same day or within 24 hours, will be open for subscriptions with me, which means that you can actually go ahead and sign documents, the legal documents that are prepared from our lawyers, stating that you do want to be an investor in this deal, and all this information is sent to you by the website and electronically. So you can do this from pretty much from your cell phone if you wanted to. And then again, the target closing will be approached shortly after that. Our goal is to make everybody aware, open up the subscriptions, and then start working on all the paperwork so that we can gather all that information around or before the targeted closing.
How long is the hold period for each investment? Each investment is a little bit different. So each deal will present you with that private placement memorandum, the PPM, as we discussed, and it'll delineate the business plan to include the holding period. Each phase takes months to years if you can think of an acquisition period, a stabilization period, and an optimization time. Therefore, the process will likely take years from start to finish. There might be some situations when, if the market is favorable or the business plan is executed in a timely manner, the property might be refinanced. Refinancing is a non-taxable event, and often the passive investors receive partial amounts of their invested money returned. To plan your finances, plan on a holding period as shown in the PPM.
Okay, so what are the risks associated with passive investing? And I would like to make a reference here to when we explain the consents for going under anesthesia, you can sit there and read all the fine print, or you can take it as crossing the street carries risk. However, just like we do it in the operating room, we have tools that we use. We have devices that can help us determine what's a good risk and what's some a risk that we can mitigate. So again, everything is going to be outlined in the PPP, all the risks that we could think of, and some of them that we could imagine. However, as you might expect, there's always going to be a part of it, of a risk that is not even known. Like before COVID happened, nobody even imagined that that was such a thing that could happen. So again, the risk is assessed during the underwriting. We underwrite very, very conservatively. So by that definition, we also engage the lenders, we engage the insurance, and by those layers of protection, we are actually sheltering or a passive investor money, because we are engaging all those tools that we have to make it safe and to mitigate pretty much as many risks as we can. But if anybody tells you that your investing is free of risk, or you're 100% guarantee that your money is going to be doing this or that, doubling, or whatever numbers they give you, my advice, or I personally will run away from that. So just make sure that you're reading your PPM and asking questions to your sponsor team.
What is the private placement memorandum? The PPM that we've been discussing is a legal disclosure that details the real estate investing offers. This document is required by the SEC to be presented to potential investors and prepared by a syndication attorney. It provides essential details and disclosures that passive investors need to know before agreeing to make their investment. Each PPM is tailored to the deal being presented, but generally will include the offering, the risks, the partnership agreement, investment summary, and a subscription agreement. The subscription agreement section includes basic information such as the purchase price and percent ownership. The risk section highlights all predictable and as many unpredictable possible risks that could happen. The PPM is not necessarily all inclusive, and it also does not mitigate or absolve anybody from the potential of risk.
So what is the role of a passive investor? Pretty much a passive investor, it's a capital partner, depending on how much money we're going to raise, or how much capital expenses to renovate the place. That's pretty much your role. You come in and provide the capital. The rest of the work, the rest of the day-to-day operation is going to be placed on the active team, which are going to be a team of property manager, lawyers, accountants, all the CPA, and all the rest of the team that are going to be carrying on the again day-to-day operation. So once the deal is purchased, and the GP will be consistent of updating you and on the status, all the renovations as they are taking place. The bank usually comes and conducts inspections to make sure that we're implementing the business plan. And along the way, you will also get those same reports that they get. So you will receive information by email. Sometimes you will do phone calls. If you ever need to reach to your point of contact, that person is going to be pretty much your best friend then for the holding time. You also get information through the reports that we send you. And this report, some of the platforms, you can download them, and they're available in your investor portal. So we try to make it very, very user friendly, and not as an burden and invasive to your regular life, but at the same time make it available so you can have it and read it and stay informed at your leisure.
What if the economy has a downturn? So what if renting market suddenly goes down and the housing market crashes? Depending on the business plan, it can be modified to accommodate an economic fluctuation. For example, if the market is on a downturn, The business plan might be to continue to cash flow and hold until the market is healthier to achieve a better price at sale. Also, depending on the property class, the mitigation of the residents could increase the demand for your specific property. For example, residents will move from Class B to Class C properties during lower income when people decrease their income or revenue, or lose a job, or have to find a lower paying job. B and C class value add properties tend to hold up much better in the downturns because folks need a place to stay. The rents are more in line with the market, service economy demographic, typically still employed in downturns versus the higher paid A class renters whose jobs are more at risk. White collar professionals.
Okay. So how long is my money invested in the deal? That's another question we get often. Some of the passive investors feel like if they put $100,000 in a deal, they don't want it to be parked there pretty much for 5 to 8 years, which might be the holding period. So again, all this information, which is the business plan and pretty much what is the team going to be doing with the property, usually includes stabilization. Then if we're gonna do a refinance, and the during refinancing, again, is a non-taxable event, and the money that we get out, the equity that we cashed out, is distributed to the passive investors. So depending on the deal, you might get 60 to 80% of your invested money back, and the rest of it stays in the deal and it continues to cash flow. So at that point of refinancing, because we increase in the debt that the business is assuming, there will be a slight decrease in cash flow. But again, you're getting your money back, some of your money back, so that you can actually take that money and invest it somewhere else. And that definition, you're reusing that money to go and get in another deal, and again, make you some more cash flow. So if you have to think of numbers, if you put $50,000 in a deal and then refinancing at 3 or 2.5, you might be getting 60 to 80% of that $50,000, which then it can be available for you to invest it somewhere else, and the remaining of that money, it stays there in cash flows. So again, it depends on the business plan of the specific property, but if that helps you think of, your money would not be tied up for that entire amount of time, depending on the business plan.
As a passive investor, who will be my point of contact? So your POC, your point of contact, is the general partner that reached out to you in the first place. This will be the person that asked you or offered you the opportunity to invest in the project. And this person will be there to help you along the way for your entire holding period of the asset. Some groups will have a designated investor relations person who becomes your full-time liaison, and they liaison with all the passive investors. GPs are active in the business implementation and daily operation of the investment and should provide you with frequent updates and answer your general questions. Don't be afraid to reach out to them, but you should probably expect them to reach out at least quarterly to give you an update on the business plan and the performance.
So how is my investment protected in a syndication? So pretty much in an apartment syndication investment, you have a percentage ownership of the company or the LLC that's holding the asset or the property. It's just like in the market, you are partially owner of that specific company. So after you sign the documents and after you come in and fund your deal or wire the money, you will receive documentation that supports that you are a partial owner of this business. Therefore, your investment is protected by the ownership of this LLC. So, and you will receive these documents by electronically, and those are to be kept until the disposition of the property. At the disposition of the property, then you'll be pretty much terminated that relationship, that business relationship with that specific LLC, and there'll be more documentation that shows that, and it will be sent to you.
As passive investors, will everyone be notified of the investment opportunity, or is there a priority list to be notified? Depending on the GP group, some inform the passive investor pool simultaneously and serve these on the first come, first served basis. Some have a selected group of preferred investors whom they will notify much more promptly. Personally, we inform all of our passive investors at once and serve them on a first come, first served basis.
So here we have, as promised, we told you that we were going to share one of our own investments. And this is actually our very first investment we did. And this is a apartment complex in North Carolina. I remember we are in Texas, so we rely on our team to bring us a deal that performs. This is a 336 units. The purchase price was 18.5 million. The debt that we acquired was 14 million. The raise that the team had to put together was 11 million. This was a 75 loan to value, 75%.
So the loan to value is in relation to the purchase price, the debt to purchase price, but the loan to cost was only 56%. So that was the debt divided by the debt plus the raise amount. And the raise amount includes the renovations, closing costs, any other fees that are associated, as well as the equity down payment that would be required by the lender in making the purchase. The interest rate for the loan was a 2.7%, and the loan itself was interest only for 24 months. All right, and then a principal payment would come into play after the 24th month. This is an interest rate. It had a floating interest rate, so that interest rate of 2.7 could fluctuate some. But the business plan showed for a refinance at 3 years. And by doing that, they would get rid of that floating interest rate and find a more appropriate long-term debt.
Yep. And later on, we will talk about, so there's been some questions that are detailed more and how to understand all this terminology. So again, we just wanted to present you with this deal so that maybe later on we can come back, and if this doesn't make sense or if you still have a lot of questions, we can come back and revise this, and you'll be surprised once that you start informing and educating yourself on understanding and speaking this terminology. When we revisit this concept, you start clicking those concepts and making sense of it. Maybe right now it might sound a little confusing, but just hold on tight, because none of this should be overwhelming. Maybe it is right now if it's the first time that you're being exposed to this terminology, but our goal is to make it like simple as possible. So the CapEx, the exterior capital expenses, is the renovations that are going to be done outside of the buildings pretty much, and it's for the community. So anything that includes external painting, maybe adding some, in this case was playground, and improving the pool, and maybe some of the garden, and just the outside, cutting trees and adding some light, because there were some spots that at night they were quite dark. So anything that includes improvement of the property and the outside. It was the budget for this was 2.25 million.
The average cash on cash, which is your annual returns on your money that you invested, you should be receiving about 11.95% on this particular deal. In general, the average deal right now that we're seeing is between 6 and 8% average cash on cash. Upon sale of this product, of this particular apartment complex, they're looking for a final multiple of 2.48, which means that they're going to multiply your money by 2.48, whatever your investment was. So on this one, if you put $50,000 in, you will get back roughly $122,000. If you multiply 50,000 times 2.48.
Yep, and the internal rate of return, the IRR, it's 15.11. It's an average for the life of the investment. So this is going to include all of your cash flow per year, and then the disposition of the property and sale.
So every deal is a little different. We've said that multiple times because that's just the facts of this career field. So the GP split on this, the GP LP split was a 30-70% split. A lot of times you'll see a 20-80. It all depends on the deal and how much work is involved, how much additional work the GP group might have to do as to how they do manage these splits. The preferred return is a 6% annual. That's what they're saying, that they're going to get you each year. You'll get 6% of your investment.
Yeah. Again, some of this, a lot of this concepts we're going to explain a little deeper. So don't be concerned if it's not captured just yet. Again, the holding period is 10 years. And depending on the market, if the market is beneficial, they might consider selling earlier, but the holding period is for 10 years. Again, remember, we are cash out refinance at year 3. So if we put $50,000 in the deal, and if we get a chunk of money back on refinancing year, that's in year 3. And then the rest of the years, holding years, which are 7 more, we're going to be cash flowing with a minimum investment in that deal specifically. Anything else you want to add here, Chris?
There is. So this deal is unique to its own. A lot of deals we see, the holding period might be 5 years to 8 years. And we're actually in a deal that the holding period is only 2 to 3 years. The equity multipliers change, as well as all those return rates and the GP splits. And we're just out here to educate you and try to make you aware of the different opportunities that are available for you to make money without having to be present to make that money.
Yeah. Another thing that we'll like to brag about, and I'll go to the next page here, and I hope you can zoom on this, but this is our 2020 K1. A K1 is a document that you will receive. And again, we talk about this in the next session, but we'll be, every deal that you go in, it's going to issue you a K1, just as the W-2 job hands you a W-2 form at the end of the year. And this reflects your income and your losses. And in this case, if you look closely here, we had a depreciation on paper, which is what the renovations that the team did to the property. They did a cost segregation study, and they redistribute that money to the passive investors. And because we put $50,000 in this deal, we got a depreciation. And the first year, remember, we invested in this in September, so towards the end of the year. And this is our K1, where we get $18,336 on paper loss. So this money, we can actually reduce that from our taxable income, passive taxable income. So again, this is just an example. This is actually our K1 that shows that depreciation in such a short amount of time. And we just wanted to share that. I am going to stop sharing the screen, and we'll open the room for questions. If you don't have any questions right now, or if you want to send them by email or chat here, I will save the chat. And I do want to be respectful of your time. And possibly what we'll do, we gather those questions and we will share them. We answer them in the next session, if that's okay with you, Chris.
Yeah, that sounds great. That's a good idea.
Yeah. So we hope that we gave you some information that makes you feel a little more comfortable, a little bit more assertive, and maybe ask deeper questions to the person that comes and presents you with a deal. Again, this was a foundation. It was more like an equalizer open chat, so that we make sure that everybody speaks the same language. So I understand that some of you might have quite a bit of experience. Some of you are already invested in some deals. So we don't want to offend your intelligence. We want to equalize the knowledge, the common knowledge in this group. So in the next session, we are going to be talking about other deeper, probably a little more confusing topics. But again, this is meant for us to formulate some of the questions that we should be asking when we're presented with this passive investing opportunities. Anything else you would like to share with the audience, Chris?
If you want to reach out to us, you can reach us at upplex.com. That's upplex.com. You can book a Calendly with us to have a meeting one-on-one. You can reach out to us by email on there, and you can also sign up to be a passive investor and receive our newsletter.
Thank you. Thanks, everybody. We'll catch up with you later. Thanks for being here.
Thank you.
Bye.